Ladies and gentlemen, welcome to the Exposure Index. Listen carefully. Today wasn't a silver rally. It wasn't a breakout. It wasn't another technical pattern completing or resistance level breaking or momentum trade materializing. Today was a stress reaction, the market flinching, the system revealing strain. COMEX pushed above $86 per ounce. Shanghai trading physical near 94. A gap so large it should vanish instantly, should be impossible to sustain, should get crushed by arbitrage within hours. Unless the metal can't move, unless the bridge is broken, unless the mechanism that's supposed to unify global prices has failed. This is how shifts in market confidence really begin. It's not with panic, not with headlines screaming crisis, and definitely not with official announcements declaring an emergency. It starts quietly. It starts with market participants simply reassessing their preferences, with big institutions gradually choosing physical settlement over paper contracts, and with procurement officers locking in their supply chains instead of just relying on the spot market. In today's analysis, we're going to dive deep into these signals. We'll track the spreads, examine the market structure, and pinpoint the specific signs that tell us whether the supply and demand balance is stabilizing or if it's still under stress. And I'll explain exactly why today's price action shows all the classic signs of a physically tight market. Today, we witnessed another significant move. Silver surged past $86 on the COMEX, jumping over 6% in a single day. That's not just a gradual rise, that's serious price velocity. According to public data, silver is now up about 19% for the year and a staggering 180% over the last 12 months. Numbers like that get people's attention, bringing new players into the market who might not have been watching this commodity before. And while Western commentators are focused on that headline price, the real story is in the structural changes happening across different regional markets. Because while COMEX is showing $86, physical silver in Shanghai has been trading near $94 based on available pricing. We're not talking about theoretical models here. We're talking about actual physical markets where industrial buyers and supply chain managers care about one thing above all, getting their metal delivered in the right quantity on time. The spread between these Eastern physical markets and Western futures is not behaving like a normal arbitrage gap that closes quickly. It's sticking around, and that persistence suggests there could be constraints in the physical delivery system that usually keeps global prices aligned. Now, market analysts have offered a few standard explanations for today's price jump. They point to a weakening US dollar, which always impacts commodity prices. They also mention geopolitical tensions in the Middle East, which typically drive investors towards safe haven assets. And importantly, there have been news reports about potential regulatory scrutiny of the Federal Reserve's leadership. Before we go any further, let me be crystal clear about something. I'm not here to comment on the validity of any political or legal issues. What matters for market analysis is how people interpret information, regardless of whether that interpretation is correct. Reports circulated today about regulatory questions involving Fed leadership. Whether these are significant developments or just political noise is not something I can determine. What we can observe is how the market behaves, and the observable fact is that precious metals moved exactly how they tend to move when market participants feel uncertain about monetary policy institutions. I'm simply describing the price action, not validating any particular story. When confidence in a central bank is independence or policy predictability seems to waver, justified or not, precious metals historically see a surge in demand. They act as a diversification tool, an asset that doesn't carry the same counterparty risk as financial instruments. Silver is part of that dynamic right now, but with an extra layer that makes its situation unique. Silver is both a monetary metal and an industrial one. Gold is primarily a hedge against a loss of confidence, a store of value. Silver does that too, but it's also a critical component in manufacturing, technology, and green energy infrastructure. This means silver responds to both monetary uncertainty and industrial supply and demand at the same time. This dual nature is why silver can experience much more dramatic price swings than gold, especially when both of these factors are in play. When you get monetary stress and supply chain tightness happening together, the price action can be explosive. Let me walk you through the framework we're using here. If you're thinking about silver as one big global market with a single price where futures and physical metal trade at the same value and arbitrage keeps everything aligned, you might want to rethink that based on the current data. We seem to be watching the market split in two. There's a paper reference price reflected in derivatives and futures, and then there's a physical access price, seen in the regional spot markets where real metal is changing hands. You have a Western benchmark for financial reference, and an Eastern physical market that shows the reality for industrial users. The arbitrage mechanisms that are supposed to keep these two prices tied together just aren't working as efficiently as the models would predict. And that observation, that structural shift, is far more important for understanding what's happening than any single day's closing price. Now, let's carefully address some of the claims circulating in the precious metals community. There's been talk about force majeure situations, delivery failures, and settlement problems in Chinese markets. We need to approach these claims responsibly. In a commodity market under supply stress, the early warning signs are rarely official announcements saying, "We have a delivery failure." The stress shows itself through observable changes in how the market functions. We look for specific data points, widening spreads between regional physical markets and benchmark futures, rising physical premiums that dealers charge over the spot price, expanding bid-ask spreads in futures, which means less liquidity, declining inventories at exchanges that aren't being refilled, changes to margin requirements, adjustments to settlement procedures, and longer delivery timelines reported by dealers and refiners. These are the signals that point to physical tightness, whether or not any official force majeure declarations are made. Force majeure clauses exist in contracts for when extraordinary events prevent a party from fulfilling their obligations, things like natural disasters or major regulatory changes. The relevance here is not whether it has been officially declared, and I haven't seen any verified declarations to that effect. The relevance is that the market's behavior and the spread dynamics we're seeing are consistent with the kind of physical delivery constraints that often precede major stress events in commodity markets. We're observing market structure, not making claims about specific institutional failures. That's a critical distinction for responsible analysis. The key insight is this. Today's 6% move, the sustained spread between COMEX and Shanghai, and the persistent high premiums in multiple regions all suggest one thing. Physical market participants are prioritizing access and delivery certainty, possibly even over getting the best price. That behavior is what we're analyzing here. So let's look at the fundamental backdrop driving these conditions. A weakening US dollar affects commodity pricing mathematically. When the dollar's value drops, dollar-denominated commodities typically rise in price to reflect that currency adjustment. This provides a baseline tailwind for silver right now. But the more compelling factor is the industrial demand side. Silver is absolutely essential for so many modern technologies. Think about solar panels, electric vehicles, 5G networks, and countless electronics. These aren't just niche applications, they are core components of global economic growth and the green energy transition. As governments and corporations around the world push forward with these initiatives, the demand for physical silver is structurally increasing. This isn't cyclical demand that ebbs and flows with the business cycle. It's a long-term secular trend. And when you overlay that powerful industrial demand onto a market that is already showing signs of monetary stress and physical delivery constraints, you get the potentially explosive cocktail we are seeing today. This bifurcation of the market, paper versus physical, is a signal that the system is under pressure. The price you see on your screen might not be the price you have to pay to get your hands on the actual metal, especially in key industrial hubs. This is the core of our analysis. We're not just looking at charts. We're decoding the market structure to understand the real story. Beyond the numbers you see on your screen, something profound is happening in the global financial system. When the dollar weakens, it's not just a mechanical adjustment, it's a signal, a sign that global capital is getting nervous about holding the world's reserve currency. It's a whisper that confidence is eroding, and investors are starting to demand a higher premium for holding dollars over other assets. Now let's add the complexity of geopolitics to this picture. Tensions in the Middle East, concerns over shipping lanes, the potential for conflict. Markets don't price in war for drama. They price it in because war changes everything. Energy routes get disrupted, insurance costs spike, and supply chains reroute. Most importantly for precious metals, geopolitical stress makes investors question the value of paper claims versus hard physical assets. Then there's the human element at the very center of the system. Reports of scrutiny over the Federal Reserve's leadership introduce the one thing markets despise most: uncertainty. When investors begin to doubt the independence or credibility of a central bank, they don't wait for confirmation. They run. They run to the simplest, safest assets they can find. Assets with the least counterparty risk, assets that don't rely on promises. They run to physical gold and silver. This is especially true when silver is already showing signs of physical tightness, with delivery times stretching out. And this brings us to what's happening with silver right now, which is far more than just a safe haven rally. Silver isn't just participating, it's aggressively outperforming. For a moment, its market action was so extreme that headlines were comparing its implied value to that of tech giants like Nvidia. When a metal moves this fast, jumping over 6% in a single session, it becomes a major global event that forces everyone to pay attention. Why? Because silver is a critical industrial metal. It's in everything. It's essential for manufacturing, technology, and infrastructure worldwide. When silver's price jumps violently, it sends shockwaves through the entire economy. Manufacturers face higher costs, refiners struggle with inventory, and governments worry about their strategic supplies. This is why the gold to silver ratio is so important. Watching this ratio fall isn't just for metal enthusiasts. It's like reading a pressure gauge for the entire market. When it takes fewer ounces of silver to buy an ounce of gold, it means silver is moving faster and appreciating more aggressively. Historically, this happens for one of three reasons: a supply bottleneck, a speculative frenzy, or a structural repricing driven by both industrial demand and monetary fear. Right now, we are seeing all three at once. Industrial demand for silver is no longer a future projection. It's a reality. The global push for electrification, from solar panels to electric vehicles and upgraded power grids, is relentlessly consuming silver. This creates a constant structural pressure on supply. On top of that, you have monetary fear acting like a turbocharger, amplifying the price moves and creating a powerful feedback loop. This is how you end up with prices like $86 on the COMEX and an astonishing $94 for physical delivery in Shanghai. And that brings us to the spread, the $8 gap between New York and Shanghai prices. This is the most critical part of the story. In a healthy market, a spread this large shouldn't exist. Arbitrage traders would normally step in, buy the cheaper metal in New York, ship it to Shanghai, sell it for a profit, and the price gap would vanish. That's how global markets are supposed to work. But this time, that's not happening. The bridge that connects these markets appears to be broken. For arbitrage to work, you need available metal, the right specifications, shipping capacity, financing, and customs clearance. It takes time. But when the market fears a shortage, everyone starts to hoard. Manufacturers, dealers, and vaults hold onto their physical inventory because they can't be sure they can replace it. Nobody wants to sell what they might not be able to buy back tomorrow. This is when the arbitrage mechanism fails. The massive price gap between COMEX and Shanghai isn't about different regional opinions. It is showing us that we are looking at two different things: a paper price based on derivatives and a physical access price for actual metal. When physical access becomes uncertain, the price you pay for guaranteed delivery detaches from the paper price. This is how markets begin to fracture. Now consider the reports about delivery issues in Shanghai. In physical commodity markets, a crisis doesn't start with an official announcement. It starts when everyone begins acting as if a failure is possible. You see it when exchanges demand more collateral, when delivery terms become vague, and when the premium for physical metal explodes. If metal were freely available, that $8 spread would have been closed in days by traders eager for a profit. The fact that it persists tells us that something is structurally wrong. It's not just expensive to move the metal, it might be nearly impossible. Let's step out of the trader mindset for a moment. Imagine you run a factory that needs silver to operate. Your entire business, your revenue, your contracts, your employees' jobs, depends on a steady supply of this metal. If you can't get it, your production line stops. You don't just lose money on a trade, you risk losing your entire business. In that situation, you don't care about the paper price on a screen. You care about one thing: certainty. You need to guarantee that you have the physical metal you need to keep operating. When you hear about delivery problems and see premiums skyrocket, you will do whatever it takes to secure your supply. You'll pay almost any price because the cost of paying more for silver is nothing compared to the catastrophic cost of having none at all. This is the real driver behind physical price spikes. It's not speculation, it's necessity. It's industrial buyers prioritizing access over cost, and it's a sign that the physical market is under immense strain. When you see Shanghai physical silver trading around $94 while COMEX is at $86, what does that tell you? If manufacturers in the East are paying $8 more than the Western paper reference price, it means one thing very clearly: someone is paying for certainty. Someone values guaranteed access to physical silver enough to pay a significant premium. Now, let's break down why silver's move today was so violent. Why did it jump 6% in a single session? Why the sudden spike instead of a gradual climb? Price doesn't go vertical for no reason. It doesn't just spike randomly. A vertical move like this is usually a chain reaction, a series of cascading effects. It starts with a catalyst, maybe dollar weakness, geopolitical tension, or news from the Fed. Then it hits the market's positioning. Speculators who were short get squeezed. This triggers margin calls. Those with leveraged short positions must either cover their trades or post more collateral. Then comes the forced buying. Liquidations automatically create buy orders, pushing the price even higher. Finally, this triggers reflexive panic. More participants see the momentum and rush in, afraid of missing out. Silver is notorious for this kind of behavior. Its market is much smaller than gold's, its liquidity is thinner than many people realize, and it's far more sensitive to physical supply constraints than purely financial assets. When silver starts moving, especially when it breaks key price levels with high volume, it doesn't move politely. It doesn't climb steadily, it snaps, it gaps, it jumps discontinuously. And when it snaps violently, the people who are short, especially those using leverage, get punished brutally. That's what a 6% day does. It doesn't just mean the price went up, it forces liquidations. Margin clerks start calling. Positions get closed involuntarily. It forces hedges to be unwound as dealers scramble to adjust their books. It forces those same dealers to widen their spreads, meaning the gap between the buy and sell price expands. It even forces exchanges to think about system stability and whether they need to intervene. The more the system reacts, the more participants sense weakness, and the more they rush toward the exit. They rush to secure physical metal, rush to establish long positions, and rush to protect themselves against further price moves. Now, let's add one more layer to understand the significance of today's events: the collapsing gold to silver ratio. Dropping to 54 to 1 from levels like 60 or 70 to 1 in recent months sends a clear message. Silver isn't just catching up to gold. It isn't just participating in a precious metals rally. It's becoming the narrative. It's becoming the focus, the metal getting disproportionate attention. And that's dangerous for the broader financial system. It's dangerous because it forces questions about valuation and legitimacy. When gold and silver run hard together, when precious metals dramatically outperform other assets, they don't just steal attention from stocks or create alternative investment narratives. They challenge the very legitimacy of the risk-free baseline. They challenge the assumption that sovereign bonds and fiat currencies are truly safe. If investors start preferring physical metal over sovereign paper, if capital flows toward physical assets and away from financial claims, the entire structure of interest rates becomes more important. Borrowing costs get stressed. A government's ability to service its debt gets questioned. The whole valuation framework for all assets gets shaky. And if the Fed is under pressure, whether from a DOJ investigation, political scrutiny, or concerns about its institutional credibility, that just accelerates the legitimacy crisis. It makes everything worse, creating a feedback loop where the monetary authority is questioned, which drives safe haven demand for metals, which in turn puts more pressure on the financial system. So how does this all tie into the concept of force majeure? How does a potential delivery crisis connect to today's price action? It's simple. Force majeure isn't a magic spell. It's not something that happens overnight without any warning. It's a confession. It's the system admitting its own limitations. It's the system saying, we cannot do what the contract implied we could. We cannot fulfill our obligations as they were written. When a major hub, like Shanghai or COMEX, can't deliver physical silver reliably, it creates immediate second-order consequences that spread through the entire market. Buyers start seeking metal elsewhere. If one source is unreliable, procurement officers diversify their suppliers. Premiums spike everywhere, not just in the stressed hub, but globally. The paper market is then forced to chase the physical market. Derivatives have to acknowledge reality. The spread between paper and physical becomes politically sensitive, and governments start paying close attention to commodity supplies. And then the most dangerous outcome can happen, the one that changes everything permanently. The market stops trusting the paper contract as a deliverable claim and starts treating it as a cash-settled game. It starts assuming that converting a paper contract into physical metal won't work. It begins pricing paper and physical as two separate products. That's the moment the paper price becomes a lagging indicator. It's no longer the leader, no longer the place for price discovery. It's just a reference number that the physical markets ignore. If you want the cleanest summary of what today represents, if you want one sentence that captures the significance, it's this. Silver is behaving like a market where physical access is being repriced faster than the paper system can follow. That's why you're seeing Shanghai physical at $94, while COMEX prints 86. That's why the spread persists. That's why arbitrage isn't closing the gap. And that's why today matters so much more than just another day when silver went up. So, what should you watch next? What signals tell you whether this is the beginning of a delivery crisis or just a temporary tightness that will resolve itself? Forget price targets. Forget the hype and the thumbnails promising specific levels. Watch the system's behaviors. Watch how the infrastructure responds. First, watch whether the spread between paper and physical compresses naturally. If it does, it means arbitrage is functioning and metal is flowing. If it stays wide and stubborn, it suggests a structural problem. Second, watch whether premiums in physical hubs like Dubai, Singapore, and Hong Kong stay elevated. If premiums remain high everywhere, that points to global tightness. Third, watch whether the exchanges respond with margin hikes, rule changes, or new settlement flexibility. Any intervention is a signal of stress management of the system protecting itself. Fourth, watch if the gold to silver ratio continues to compress. Silver outperforming gold usually means the move is driven by supply urgency and industrial necessity, not just a general flight to safety. Finally, watch what happens when the next wave of delivery demand hits, when contracts stand for delivery and physical settlement is demanded. And that's when the narrative meets reality. If the system is healthy, it absorbs the demand. Metal appears and deliveries are completed. If the system is stressed, it does one of two things. It either reprices aggressively to ration demand, meaning the price must rise high enough that marginal buyers back away, or it changes the rules. That means force majeure, cash settlement, or delivery restrictions. And when the rules change, when the system admits it cannot function as designed, confidence breaks and trust evaporates. Now, I'm going to say something that might make people uncomfortable, but it's true and you need to hear it. The most dangerous part of this situation isn't that silver is at $86. It is not that it jumped 6% in a session, or that it's up 180% in 12 months. The most dangerous part is that people still think the price is the price. They still believe the number on the screen represents what the metal actually costs. In stress events, during delivery crises, during physical shortages, the price becomes a spectrum, not a single number. It becomes a range. You have the paper price shown on futures exchanges. You have the allocated price, which is what you pay for specific segregated bars. You have the retail premium price that dealers charge above spot. You have the industrial bid price that manufacturers pay for guaranteed supply. And you have the emergency procurement price, what you pay when you absolutely must have the metal immediately. The moment you see Shanghai Physical at $94 while COMEX is at $86, you are seeing that spectrum open up. You are seeing that bifurcation manifest. That's not just bullish excitement or speculation. That is market fracture. It's the system revealing that it cannot function as a unified whole. Before I close, I want to address the psychology trap that destroys people in markets like this. It's the mental error that costs fortunes. People see a vertical move, a 6% day, a parabolic chart, and they say, it went up too fast, it has to come down. Mean reversion, it's overbought and due for a correction. Sometimes that's true. Sometimes vertical moves are speculative blow-offs that reverse hard. But when a market is repricing a physical constraint, when industrial necessity meets a supply shortage, when delivery becomes uncertain, it doesn't behave like a normal speculative market. It behaves like rationing. It behaves like a market discovering a new, much higher equilibrium. And that rationing continues until one of three things happens. Either supply appears from new production, inventory releases, or the end of hoarding. Or demand collapses, because industrial users find substitutes or buyers simply back away. Or the system breaks and reboots under new rules. Force majeure, cash settlement, market restructuring. So if you're trying to trade this like a normal chart pattern, applying technical analysis designed for liquid financial markets, you're playing the wrong game. This isn't just price action. This is structure. This is macro confidence meeting industrial scarcity. This is dollar weakness, plus geopolitical stress, plus institutional credibility risk. And silver, the smallest of the big markets, the metal everyone underestimated, is finally reacting like what it actually is: a strategic industrial input, a monetary escape hatch, and a supply chain bottleneck. So here's the question I want you to answer in the comments. The question that reveals whether you understand what's happening. Do you think the spread closes because COMEX reprices higher, because Western paper follows Eastern physical reality? Or does it close because the system changes the rules, because exchanges intervene, because force majeure gets invoked to prevent a complete breakdown? Type 1 phrase, COMEX chases, or rules change. Because one of those is how this whole thing ends. One of those is the final resolution mechanism. And if you're watching this video right now, if you found this analysis before the mainstream media machine even knows what to look for, you're early. You're early enough to think clearly, to cut through the noise, and to position yourself appropriately. You're in a position to understand what signals truly matter. Most people, and I mean the vast majority, only start paying attention when it's already too late. They start thinking when the dealer's shelves are bare, when the out-of-stock signs are everywhere, and when the news headlines finally admit what the market spreads were screaming for months. By then, the opportunity to act calmly and rationally is long gone. It's panic time. But you're here now. Let's break down what's happening. The COMEX is the major futures and options market for trading metals. The whole system is built on a promise, the promise of delivery. You hold a contract. You're supposed to be able to get the physical metal. But what happens when that promise is tested? What happens when more people than usual stand for delivery? That's when you see the stress fractures appear. This isn't just theory. We're seeing the signs in real time. The spread between the paper price and the physical price is widening. Think about it. Why would a physical ounce of silver or gold cost significantly more than the price you see on your screen? It's a disconnect. It's the market telling you that the physical metal is much harder to get than the paper contract suggests. This spread is a fever. It's a direct measure of the system's stress level, and right now that fever is climbing. This brings us back to my original point. COMEX chases, or rules change. COMEX chases means they have to scramble. They have to go out into the global market and find the physical bars to satisfy delivery demands, often paying a huge premium to do so. This can cause massive price spikes and volatility. It's a sign that the paper tail is no longer wagging the physical dog. The physical demand is taking control, and the paper market is forced to react or chase the real price. The other possibility? Rules change. This is the part that should concern everyone. When a system is under existential threat, those who control it can simply change the rules of the game. This could mean a lot of things. It could mean they settle contracts in cash, even if you wanted the metal. They could change delivery terms, locations, or quality standards. They could halt trading. This is often referred to as force majeure, an unforeseeable circumstance that prevents someone from fulfilling a contract. But a force majeure doesn't always come with a big, official announcement. Sometimes it just happens quietly through behavioral changes. Delivery delays get longer, premiums skyrocket. The hoops you have to jump through become impossible. It's a de facto default, even if they never use the word. Every major delivery crisis in history begins this way, with subtle shifts that escalate until the whole system locks up. So what's the takeaway here? The story isn't going away. This isn't some temporary blip that will resolve itself next week. The pressures are accelerating, the spreads are widening, and the system is showing more and more stress. We are witnessing the early stages of a major repricing event, a moment where the market is forced to reconcile the paper promises with physical reality. Being early means you have the luxury of time. You can educate yourself, you can understand the difference between paper assets and real assets, and you can make decisions without the pressure of a full-blown crisis looming over your shoulder. By the time the headlines catch up, the game will have already changed. If you find this perspective valuable, stick around. Like this video, subscribe to the channel, and hit the notification bell. We're going to keep tracking these signals week by week, because understanding how this ends is the key to navigating what's coming. This isn't just about charts and numbers. It's about seeing the structure of the market for what it is and preparing for the inevitable conclusion. Stay close. Thanks for watching.